Hey everyone, Jordy here. Welcome back to another episode of Retire on Dividends. So, last time we dove deep into SCHD and those massive changes in the 2025 reconstitution. I've been getting tons of messages from you guys about that episode. Thanks for all the feedback. Today, I want to take a step back and talk about something that might seem completely different from our usual dividend focus, but trust me, there's method to my madness here. We're going to explore Boglehead investing principles. Now, if you're wondering, Jordy, what the heck is a boglehead? I get it. I was in the same boat years ago. Bogleheads are followers of Jack Bogle's investment philosophy. Jack Bogle was the founder of Vanguard and essentially created the first index fund for everyday investors. And his approach has some serious wisdom that I think can complement what we're doing with our dividend portfolios. Let me tell you a quick story. When I first started investing, I was jumping around like crazy, chasing yields, trying to time the market, picking hot stocks based on tips from coworkers. Man, I made some embarrassing mistakes. There was this one energy stock, I won't name names, that I was sure was going to explode. Put way too much money in it and, well, it did explode, just in the wrong direction. It wasn't until I stumbled across Bogle's philosophy that I started to get some discipline in my investing approach. And honestly, many of these principles have shaped how I approach my dividend investing today. So, what are these core Boglehead principles? Let me break them down for you. First up, low costs. This is absolutely critical. Every dollar you pay in fees is a dollar that's not compounding for you. I remember looking at my old 401k statement one day and realizing I was paying almost 1.5% in expense ratios for actively managed funds. That might not sound like much, but over decades, that'll eat a massive chunk of your returns. With dividend ETFs like SCHD, we're usually getting expense ratios around 0.06%. That's incredibly low, and one of the reasons I advocate for them. Second principle, diversification. Bogleheads are big on not putting all your eggs in one basket. Now, this might seem at odds with how I've constructed my portfolio. Yes, I have a large position in SCHD. But if you look under the hood of SCHD, you're getting exposure to 100 high-quality dividend stocks across different sectors. So even within a concentrated position, there's built-in diversification. Third principle, buy and hold. This is where I think dividend investors and Bogleheads have complete alignment. It's not about trading in and out. It's about finding quality investments and letting them work for you over the long term. Some of my biggest investing regrets come from selling too early because I got nervous during a market dip. Fourth principle, simplicity. Man, I wish someone had drilled this into me earlier. Your investment strategy doesn't need to be complicated to be effective. In fact, complexity often leads to mistakes and higher costs. Some of the most successful investors I know have the simplest portfolios. Now, here's where traditional Bogleheads and dividend investors like us might differ a bit. The classic Boglehead portfolio is often what they call a three-fund portfolio: a total US stock market index fund, a total international stock market index fund, and a bond fund. The idea is to own essentially everything at the lowest possible cost. In our dividend strategy, we're more selective. We're looking specifically for companies with strong dividend histories, good fundamentals, and growth potential. We're willing to be a bit more concentrated in exchange for higher current income and dividend growth. But here's the thing, I don't think these approaches need to be mutually exclusive. In fact, I've incorporated elements of both in my overall financial picture. Look, I've learned through a lot of trial and error that there's no perfect investing strategy. What matters most is finding an approach that makes sense to you fundamentally, lets you sleep at night during market turbulence, you can stick with consistently over decades. For me, dividend investing checks those boxes. I love seeing those dividend payments hit my account each month. It gives me a tangible sense of progress even when the market is going sideways or down. It keeps me from making emotional decisions because I'm focused on the growing income, not just the fluctuating account value. But I've also learned to appreciate the wisdom in the Boglehead approach. There's something powerful about keeping costs low, staying diversified, and keeping your strategy simple enough that you don't outsmart yourself. So here's what I'm suggesting. Whether you're all in on dividends like me, or you prefer a broader index approach, or maybe some combination of both, just make sure you're applying these fundamental principles. Keep your costs low, stay diversified, even within your dividend portfolio. Commit to a long-term horizon and keep things simple enough that you actually understand what you own and why. I'd love to hear your thoughts on this. Do you incorporate any Boglehead principles in your dividend investing? Have you found a balance between these approaches that works for you? Drop me a comment or send me a message. If you found this helpful, please hit that like button and subscribe to the channel. It really helps more people discover these ideas that honestly took me years of mistakes to figure out. Until then, keep building those dividend snowballs